It's important to preface this by emphasising that when working with an accrual accounting system, we match expenses when they're incurred against revenue when it's earned, and thereby provide or generate an accurate measure of profit. By doing so, we satisfy the reporting period principle as well as the relevance QC. Now, when determining if something is an expense or not, or indeed justifying why something is an expense, there's three boxes we need to tick. Firstly, did the financial event result in either an outflow of an economic benefit, which occurs when we pay cash for items such as wages, the bank balance goes down, or was there a consumption of an economic benefit, which is what happens when we have depreciation, or was there a reduction in inflows, like what happens when we allow discounts to our debtors. The second criteria, the financial event must have resulted in either a decrease in assets or an increase in liabilities. If it doesn't tick either of those criteria, then it's not an expense. And finally, it's got to result in a reduction in owner's equity apart from the caveat drawings due to the entity principle. So I want to walk you through three challenging examples. We'll start with a discount allowed to a debtor. Step one's quite relatively straightforward. We identify it as an expense. Step two, we need to be careful here. We need to identify the three criteria that I mentioned on the first slide and be very careful with criteria number one, because a discount allowed is not actually an outflow as such we have when we pay wages, etc. It actually results in a reduction in the inflows. That's the first criteria. A reduction in the inflows. We're actually going to get less money from the debtors ultimately. Results in a decrease in assets, second criteria met, and a simultaneous decrease in OE. Now, you need to link that to the actual scenario of a discount. So the discount allowed will result in a lower figure or less receipts from our debtors, which decreases the balance in our debtors' control, as well as the simultaneous decrease in net profit. Okay, example number two, bad debts. Okay, step one, we identify as an expense. Step two, with our definition, we work through the three criteria on the first slide of this presentation. So again, bad debt does not result in an outflow of an economic benefit, but rather a reduction in the inflows. Thus, there's a loss of economic benefit that results in a decrease in assets as well as that simultaneous decrease in OE. Make sure you specify these two. So let's link that to the actual scenario of a bad debt. The irrecoverable debt has reduced the accounts receivable, which results in a decrease in the balance in the debtor's control as well as net profit. Final example, let's look at depreciation. Step one, identified as an expense. Step two, work through your definition by actually addressing the three criteria. And again, depreciation does not result in an outflow of an economic benefit, rather than a consumption or a partial consumption of the economic benefit over part of its useful life, thus resulting in a decrease in our assets as well as a decrease in owner's equity. So let's link it. The vehicle's revenue earning capacity has been diminished due to wear and tear or maybe obsolescence, etc. Thus, the partial consumption of the asset has been recorded along with a consequential reduction in net profit. Hope that helps.